Welcome to You and Your Money. I'm Jim Zahansky, Principal Managing Partner and Chief Strategist at WHZ Strategic Wealth Advisors. Let's dive in to today's episode.
Today, we're taking a comprehensive look back at what's been a remarkable year for both the markets and the economy in 2024. So we're looking right now about the markets, and then we flash back to the rest of 2024.
Yeah, I mean, it's clearly been a really good year. But if you do, we're going to spend a lot of time looking back and understanding whether the economy performed and the markets performed the way we all thought they would this year. But interestingly, when you think of this year, I mean, really the United States economy and the stock market, they definitely proved to be more resilient than many expected. And I'll talk through that in a bit. But really the economy's on track to grow when we look at gross domestic product, about 2.7% this year. And with that, the S&P 500, which is one of the main indices we look at in terms of overall stock market performance, and it's risen more than 25% with only a few more weeks remaining in the year. So when you think of that sort of performance, both growth in the gross domestic product, that's the measurement of the economic growth, and then the market growth that corresponded to that, surprisingly very strong based on where we started the year. And so what's happened? Why has that happened? And I think it has a lot to do with the U.S. job market and the consumer. And you'll hear about this more in our talk, but I mean, really, we've been able to reduce the interest rates this year, keep jobs going, and continue to have people spending, considering that as people have jobs, they have more money to spend. So sort of the realistic approach to how the economy has accelerated this year. And for the U.S. equity markets, I mean, really the S&P 500 has allowed companies is responding to companies who are meeting their earnings. They're exceeding earnings expectations. And so, clearly as we look at the markets year to date with that sort of growth in the stock market and the bond market's doing fairly well as well, we remain fairly optimistic in our investment committee, really that the economy and the markets will continue to perform well, perhaps not at the same rate they did this year, but certainly continue to perform well as we look at a more accommodative stance from the Trump policies, as well as an interest rate lowering reduction cycle from the Federal Reserve. So all in all, if you're a listener on the radio right now and you've been invested in your 401k or some other portfolio, hopefully you've seen the sort of growth I'm talking about, as clearly it's been a strong year in the stock market.
And Jim, you touched on the lowering of the interest rates this year. Is the fact that the numbers are the good that you talked about, the fact that the Fed apparently knew what it was doing? It looks like that those lowering interest rates had an effect on what happened in 2024.
Well, exactly, Wayne. Like it did in 2022, but in an adverse way, when rates rose at the highest rate of any time in our lifetime, even past the 70s, in terms of a rate increase, the markets responded negatively. Why? Because companies that borrow money are paying more for it. Same with the government, right? And so as interest rates come down, the borrowing costs are lower, and therefore earnings can improve. And therefore, at a very simple level, there's a lot more behind that. At a very simple level, when interest rates are lower, stock markets can perform at a better rate. And so you're exactly right, where the markets are anticipating more interest rate cuts, and that's something we'll clearly have to watch as the new Trump policies take effect as he enters the presidency in January.
All right, on to your insights about the big financial changes and impacts of this year, and let's start with what might be the biggest surprise of 2024. I remember a year ago, they're all the naysayers and all the arm wavers are saying, we're going to be in for a recession. It never happened. Tell me more about that.
Well, you kind of hit the nail on the head earlier when you said, hey, the Fed has done a pretty good job, right? And, early in this year, we came into it with the prospect of really high interest rates. Every listener on here is probably frustrated by the amount of money they were paying at the grocery stores. Maybe their car loans were higher. Maybe their mortgage rates were higher. But at the end of the day, it seemed that, conventional wisdom suggested the economy would, in fact, contract with all that. But the reality was, it just seems like people continued to have jobs. The job market stayed strong with unemployment rate really hovering around that 4%, so almost full employment. And with that, we've had remarkable resilience. So, through the start of December, we've maintained this strong economic growth that I was talking about at about 2.7, 2.8% for the year in gross domestic product. That's because the Fed has lowered interest rates, lowered inflation by doing it, and people have remained working, which allows all of them to spend money and companies to ensure that are traded publicly, for the most part, are hitting their earnings targets, which keeps the markets up. And so much more resilient marketplace than we thought coming into the year, and a lot of it has to do with a successful monetary policy with the Federal Reserve.
So what do you think has been driving this economic resilience?
It's been two things that I've sort of talked about. It's really the delicacy and data-driven interest rate reductions by the Federal Reserve, which they basically said, hey, we're not going to lower the rates unless we see inflation coming down at our clip, right? So they obviously have what's called the dot plot. They're looking at this data, and they're going to lower interest rates when they felt the data suggested it with inflation. That they did a pretty nice job at, because it seems as if interest rates have come down, inflation has come down, and unemployment has remained very low. And so that's, I think, the two drivers, in our opinion, in our investment committee, when we look at the factors driving markets, it's really driven by the fact that unemployment has remained very low. Most people are employed. Wages have increased, and they continue to spend money because inflation has come down.
Now, we talked about the Federal Reserve, but they did make some significant changes this year. Walk me through how that strategy worked.
Yeah, I was just alluding to it in the sense, that they were very data-driven. I mean, they sort of had, as we began the year, everyone was calling for a recession and wondering when interest rates would come down. When would the cost of borrowing and inflation be lowered? And so they really became, data-driven. But essentially, they executed a preemptive pivot. They did not wait for some sort of economic distress, some sort of recession, some sort of major unemployment pivot, right? They sort of preemptively said, hey, we're seeing rates, we're seeing inflation come down, we're seeing unemployment stay steady. Let's keep it there. So, they then cut rates in September, and so far, they've implemented 2 rate cuts, which total about 75 basis points, or 0.75 percentage points. So, that means the cost of borrowing has lowered about that. And as we look ahead, we expect 2 to 3 cuts in 2025, which would be nice for all of us that are borrowing, and that should bring likely the Fed funds rate, that sort of overnight borrowing rate by banks, down to the 3.25% or 4% range, which is really good news for those of us borrowing money.
Jim, how have those rate decisions by the Fed affected everyday Americans?
Yeah, I mean, all the people listening, to us right now, in some way came into the year and they said, okay, we're paying a lot of money for everything. And when are these rates going to come down? When is inflation going to come down? And we sit here in December and holiday season, and I'm hoping your listeners are surprised by how well they've done this year, either if they've been invested or if they've remained employed. All of those things have seemingly, at least at a national level, gone very well. But to your question around these rate decisions, so people wanted rates to be lowered to lower inflation. And despite these rate cuts, I was saying, that's almost a percentage points cut in interest rates this year. Basically, the 10-year Treasury yield, this is the Treasury notes, when you buy these Treasuries, that's government debt, that yields at 4.3%. So it's not as low as you might expect, even considering these Fed fund rates cuts by the Federal Reserve. This is because the 10-year number is more of a forward-looking number, and it basically has created some challenges and some opportunities. I mean, on the mortgage front, rates have gotten better from the beginning of the year, but a 30-year mortgage is still sitting in the 6s, which is on a historical level pretty good, but in the past 5 years, it's pretty high. And I think the other thing is it's certainly, the government's paying more to service this debt. So if you own those treasuries, it might be a good thing. But from a government perspective, it's costing them more to own the debt because, the yield is still pretty high. I think if you've saved money in the banks, or if you're using some sort of online, money market or CD for the first time in many years. You're getting meaningful interest rates, above 2-3%, maybe even 4%, depending on how long you're locking that up for. So that could be beneficial for those retirees that have, that are listening today. And so that's sort of the yin and the yang of these Fed rate decisions, Wayne.
And a little update for the storm situation. Windham has now closed. No school in Windham today. Jim, let's turn to the stock market. What's behind the impressive gains we've seen this year?
Yeah, I was thinking before, as we opened the show, you said, what's the market update look like? And the S&P 500 is up 25%. We've got really strong 2-year numbers here, right? Sort of recovering from 2022, which wasn't great. But I think, when we look at it in our investment committee, this performance probably been driven by several factors. First, the economic resilience that we have talked about in the past, and we've been saying on these shows all year, which is lowering interest rates and keeping jobs will keep the markets high. And that's happened. So that's a really positive thing. The second is really the Federal Reserve has done a nice job at pivoting to cutting rates, and it's been well received by investors. So, investors have more confidence that the Federal Reserve will make the right decisions on interest rate cuts, which will lower the cost of borrowing and allow companies to meet their earnings goals that are publicly traded. And really, I think finally, one of the things that came out of our investment committee last week is there's general optimism about the economic future in the United States in particular, and the policies supporting it. And that's sort of boosted general market sentiment in a positive way.
And from the Department of Supply and Demand Department, the market being up so much, does that make stocks more expensive?
Yeah, that's certainly one of the things we get concerned about, right? So even though I just said sentiment is good and people are working and earnings are being met, what's interesting when you look at this from a forward-looking perspective, so one of the things we always look at is what are these price per earnings ratios trading at? So, what's a given company trading at from its price, its stock price, to how much its earnings are? And so, not to, whenever I give all these numbers on the radio, it can get a little flustering, especially if you're driving in the snow today. But essentially, we look at this forward-looking price per earnings ratio. It's now at 22, and that may mean nothing to anyone that's listening. But it just from some perspective, it's well above that 30-year average of 16.8. So you can see, that basically the markets are priced pretty high right now. And we've only seen higher valuations than this twice in the past 25 years, Wayne. And that's why, when we consider this and we look forward, we definitely think that the incoming, presidential policies will be stronger for the economy than as we sit right now, and that could be positive. However, historically, when markets trade at these levels, we're always open to sort of a resetting, and we'd always recommend to listeners to make sure they're diversified. Take appropriate risk levels, and it always has to be to your own situation. Don't always feel like the markets are always going to go up, because they're trading quite high right now, and there could be a correction at any point.
All right, so you've talked about the importance of portfolio rebalancing to maintain appropriate risk levels for each client situation. What does rebalancing mean for the listeners who might not be familiar with that term?
Yeah, for those that have 401ks, and they probably get a note from their 401k provider at times. Have you rebalanced, or do you want to set up auto rebalancing? And really all that means is sort of a process that periodically adjusts your portfolio back to its target allocation. So what does that mean? Well, if say you're 70% stocks and 30% bonds, and in this year, the stock market performance, as I've been saying all show, has been really good, right? So many portfolios in that case, because stocks have out-earned bonds, may be more heavily weighted towards stocks than they might have intended. So they may be at 75% stocks, 25% bonds versus what their target allocation is, 70-30, and they're taking more risk. Some may want that, but when you rebalance, you're going back to your original strategy. And it's something to really look at, particularly when stocks are trading so high. Take some of those earnings off the table, rebalance towards your strategy, be sure you're well diversified.
I'm guessing that some people just put their stuff in their investments and leave it alone. Notice I'm raising my hand right now. But it sounds to me like you're saying that you should probably think about rebalancing maybe on an annual basis.
Yeah, I mean, some people do it, like it a couple times a year, but certainly it's something to look at with your advisor, or if you're looking at, your 401k. Just be sure you're comfortable with the risk you're taking, right? Because the more you have in stocks, the more risk you're taking. If you're comfortable with that, then good. If you're not, then rebalance it.
We talked so far about the 2024 financial year in review. Let's get the crystal ball out. When you look ahead to 2025, what are the analysts expecting?
Well, a year ago they were expecting us to be in a recession and people were pulling out of the markets. And, these sorts of things we always coach our clients to really try to be headline agnostic. What that means is don't listen to the news every day about what's going to happen. And the prognosticators generally understand the economic conditions. So a lot of the stuff I've talked about, we understand, right? What we don't always understand is what are the things that are going to drive markets up or down. So yes, we're sitting here at a time in which the policies that are coming from the government are favorable towards growth in markets. With that said, markets are also priced pretty high. So, between those two things, we would expect that over the next year, you'd have a runway of strong performance, but not to the degree in which we had this year. It's hard to get 25% growth in the S&P 500, never mind 2 years in a row. So as we look ahead, I think one of the lessons that everyone should have learned this year is don't listen to the headlines. Stay invested if you're a long-term investor. Make sure you're in your strategy, and if you stay in and take the highs and the lows, your average will be much stronger. Just make sure you're paying attention, that you're taking the right levels of risk that you're comfortable for, and have the right amount of money invested that helps you reach your future goals. And so that's the biggest lesson I could convey as we end 2024 is stay in your strategy, learn to stay invested, and as we move forward, markets likely will be strong in 2025, but not to the degree they were in 2024.
What would you suggest investors do as we head into 2025?
Yeah, I mean, there's one of the things that we always suggest is, are you on track to achieve your goals, right? Because your investment strategy has to be linked to something. What are you trying to achieve? Many people might be trying to achieve replacing their income. When they retire, they were making money from a job. Now they need to take money from Social Security, and hopefully they've saved in some sort of portfolio or have a pension. And so as you look into 2025, what are your income needs? What are your goals? What are you trying to do? And is the amount you have invested aligned to those goals? Are you able to get the income off that portfolio that you need? And that's a really good planning opportunity to talk to your advisor about, or if you're doing this stuff yourself, don't look at it and say, we're going to make the same amount next year in our portfolio. You have to sort of normalize that a bit and say, we're probably going to do less, and can we do it? So I think as you do every time you end a year, how did I do this year? What do I need next year for my goals? And how am I going to get there is always a really good conversation to have with your advisor, and what adjustments I would make to my portfolio to get that done.
Jim, define that term goals. I hear it a lot when it comes to financial planning and the like, and I think that we all say, well, my goal is to make a bunch of money. But I think it goes beyond that. So when people talk to you about their goals, give me some examples of some different goals that different people have.
Yeah, at a very basic level, retirement income planning is probably the biggest planning goal anyone has, right? At some point, you either slow down working or you stop working, and that's a really big goal. And you have to think about, well, when I stop working, how many years do I have, for my lifespan, and how am I going to replace that income that I need? That's the pure basic goal. Then on top of that, many people have travel goals, or maybe a second home goal. Maybe they want to sell their primary residence and buy a condo somewhere. Maybe they want to move to Florida and reduce their state tax. Maybe they want to travel on more cruises. Maybe they want to leave a legacy goal to their children or their family. These are all types of goals that different people have, and financial planning is a really strong tool to help clients achieve that sort of goal making, and the portfolio management is a way and a means to an end to achieve those goals over time.
More good information from Jim Zahansky. Before we wrap things up, Jim, anything else you want to share with our listeners?
Yeah, I would, like I've been saying, it's been a really strong year. We should be positive in terms of the markets, right? And it's important to remember that, as we look forward, as I've been sort of saying, is the effect of the markets going forward could be dampened, right? They're trading pretty high. So this past performance doesn't always guarantee the exact same future results. So think about that. Think about what it means, and are you positioned well enough in your portfolio, as I said, to meet your goals? And I think that's the biggest thing I could leave for clients. Let's celebrate a really strong year in the markets. Hopefully you've remained employed. Hopefully you've saved. Hopefully you're going into the holidays stronger than you did when you started the year. And if that's true, that we should celebrate it and make sure that as you go forward, you can't expect the very same thing to happen without some sort of planning.
All right. Thank you, Jim.
Investors should note that diversification does not assure a profit or protect against loss in declining markets and cannot guarantee that any objective or goal will be achieved. For more information regarding wealth management and customized financial planning with WHZ Strategic Wealth Advisors, please visit WHZwealth.com. WHZ Strategic Wealth Advisors offer securities and advisory services through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency. They practice at 697 Pomfret Street, Pomfret Center, Connecticut 06259, and 392A Marrow Road, Tolland, Connecticut 06084. They can be reached at 860-928-2341. WHZ Strategic Wealth Advisors do not provide legal or tax advice. The tenured financial services team strives to support clients in achieving their financial life goals while providing absolute confidence and unwavering partnership for life.